Hi, everyone. We're going to let everyone join this meeting and then we will get things started in just a minute. It looks like we've got a number of people joining all at once at the start, so we'll let people just have a second to get on and then we'll get things started. Okay, well, let's get things started. Hi, everyone, and good morning. I want to thank each and every one of you for joining us today for our webinar, Ditch Debt and Boost Your Credit. Today, we'll discuss real-life examples to clarify debt management, dispel myths, and highlight how you can manage and overcome debt in your finances. We do have the Q&A feature available, so you can submit questions through that option, and if there's time at the end of this session, those questions will get addressed. You can also submit any questions to us via email at bschultz@yoursummit.com, and I'll display that towards the near the end of our session today as well. Now I would like to introduce our panelists joining us for the discussion today. First, we have Nicole Hopkins, the Strategic Relationships Lead for Tax Law at Exemplar Companies. She brings deep experience in private banking, mortgage lending, and financial planning with past roles at companies like MidFirst Bank and CMG Financial. She has helped clients navigate complex financial decisions using tools like FHA, VA, USDA, Jumbo, and HELOC products. Nicole is a passionate advocate for financial literacy, sharing her insights on platforms like TEDx, Hulu, The Skim, and others. Our second panelist, Brandon Schultz, is the Director of Operations for Investments at Summit. Brandon has nearly a decade of experience across investment banking, accounting, and industries. With this experience, he's able to bring knowledge to clients in multiple areas of their financial lives. Brandon is client-focused and values educating America's workforce on how to improve their financial lives as well as help them achieve their unique financial summit. And now I will pass it over to Brandon to get us started.
Thank you, Matthew. Well, this is a really important topic. Thank you all for joining. Really important topic that really we've been wanting to cover for a while. And I was looking back on my notes all the way back to, believe it or not, 2021 when we first started thinking about running these quarterly webinars for, financial wellness and overall financial health. And this was one of the topics that I wrote down, at the very beginning, and it just never really came to fruition. Never really had the right partner. And so I'm really happy that we were able to get connected with Nicole today. And I'm really excited for what we are going to be talking about today because it is extremely important. And in all reality, this is not, some niche topic that affects only a few people. It really affects everybody. In fact, it really is one of the biggest drivers of expenses for some people that may not be managing debt well as well, kind of getting in that hole that looks like it's impossible to climb out of. And really, there's a reason why when we're doing financial plans that we ask individuals about their budget and then look at debt structure as one of the first things that we're really looking at because it's such an important part of a financial plan. So I think sometimes in this industry we get really fixated on the savings part of finance and not enough at the expenses and debt and getting under the hood and looking at what is driving some of our expenses. So I think what we are going through today, Nicole, falls right in line in the category of what we should have learned more about in high school instead of algebra. I may be a little bit biased there. So sometimes maybe I just wasn't as good at algebra as I should have been, and I like this stuff a little bit better. But certainly something that I wish everyone was more educated about. And so I'm really hopeful that today is a great opportunity for us all to learn, more about debt, credit scores, and how to navigate them. So fortunately, Nicole, we have you on today who you are very passionate about educating, on these topics. So I'll let you take us from there.
Awesome. Well, thank you guys for having me. Everyone, I'm Nicole. I am just really passionate about financial literacy, primarily because of my own story. So, years ago, I bought my first home. It was my dream come true. I invested most of my savings into it. And I knew it was going to be a renovation project. I had about $25,000 set aside to do so. But the $25,000 I had quickly turned into a need for 75,000 as we uncovered some structural issues and termite damage and different things that we just didn't know about when I had bought the home. And so really what happened is my credit card utilization skyrocketed. I'd just become a private wealth banker. I was so embarrassed because what private wealth banker has a bad credit score? And so I didn't talk to anyone about potential solutions or what might be a better way to finance the renovations that I needed. And so it really dug me into a hole of shame and embarrassment. And I decided after that, from now on, I'm going to be financially literate and I'm really going to learn this. So the interesting thing is in the United States, over 90% of Americans report being stressed about money at least some of the time. So 9 out of 10 think about your office, your families, that's the majority of us. And 68% of Americans would rather talk about their weight than money. I don't know about you guys, but I don't want to talk about my weight either. So, the data also shows us, though, as we talk about finances, our net worth grows, right? So, I typically tell people start with realizing and becoming self aware of what is your story and your relationship with money. So, I always share this photo of my niece and I grew up super blue collar. There were some times where the electricity might go off, or we might not have the money that we needed to do an extracurricular, right? So I grew up thinking about money in this scarcity mindset of there's never enough of it, we really need it. Transition that into working in private wealth where so many of my clients were millionaires and it was a level of money I wasn't even sure what to do with. So I kind of learned these two sides of the coin. So what I always tell people as we get into these conversations about money is what's your money story? What did you grow up thinking about money? I know, Brandon, we've talked some about this. Maybe you could even share what's part of your money story.
Yeah, absolutely. I think I was, I really come from a middle class family. My dad was a firefighter, ended up being a fire marshal. My mom really was a stay-at-home mom, so kind of went from that the firefighter deal, which was really interesting to grow up in. I gotta say, I was very fortunate to grow up with a dad that was a firefighter. It's like the coolest job your dad can have. But we were definitely middle class, certainly, weren't hurting for anything necessarily, but also, didn't take a lot of big extravagant trips either. I really learned from my parents a very good responsible use of money. They really instilled that in us, where living below your means is important, saving is important, and really they helped educate me from an early age, and I'm so thankful for that education that I was given. Part of my money journey I brought up before is I asked for a mutual fund for my 11th birthday, which what 11-year-old asks for a mutual fund for their 11th birthday? But I bring that up in education before because I've kind of always been a finance nerd in life, and it really started at a young age. In high school, I took an economics class. I was fortunate enough that they offered an economics class, and I just loved it. And so that really continued on that path of, like you were saying, financial literacy, understanding finance, and of course, kind of pushed me into the career that I have today. So I really am thankful for my story. I know it's not as similar to others, but again, I think looking back and being really thankful to my parents for instilling some good knowledge into me early.
Well, that is really awesome. I will say things are a little different than me in that I have never been a super finance person. It wasn't something I studied in college. And so I didn't really grow up with a background of it. Some things I tell people about as you're thinking about your own money journey, right? You know, it was interesting when I was in college, I worked 4 jobs to put myself through college. And one of them was at the Family Video. I don't know if any of you have been to Family Video or Blockbuster, but every Friday and Saturday night, I was stocking shelves with DVDs. And at the time, I was attending a private university, and I was so embarrassed that I had 4 jobs. So I didn't tell my friends. They would ask where I was. I'd say I was hanging out with family. And what's interesting is how your money story can change, right? Nicole 14 years ago was so embarrassed of that. Nicole now puts this slide in every single presentation I do because I'm so proud of the work ethic it took. And this is something that comes up in every job interview I have. So what sometimes seems like a negative really can be a positive down the road. One of my favorite quotes is, people without money skills often make poor financial choices, no matter how much money they have. So we're going to do a short quiz to test this. I think, let me check real quick. Oh, a couple of my slides pulled out. That's okay. Okay, so I want you guys to think about, and you could even put in the chat, imagine you are a physician, and as a physician, you are making $2 million a year, right? That's how much is coming in through your paycheck. How much cash do you think you typically have in your bank account on a given day? And you've been this physician for, let's say, 5 years. So you've had about 10 million come through in the past 5 years. How much cash do you think you have in your bank account? I'll let you think about that, give an answer. And now I will tell you from experience as a private wealth banker, I oftentimes saw that number to be under $50,000. So we have $10 million coming through, less than 50,000. If you're like the people I've done this presentation with in different places, a lot of times they expect that number to be much higher. But the truth is, it doesn't matter what you earn if you don't know how to manage it. So one of the things I really like to focus on in these presentations is, how do we manage our money? A little bit about budgeting, but also, what even is credit, right? When we bring up the subject of money, it's oftentimes money in my accounts. I need to borrow money because I need more money. So we will kind of transition that now into what makes up credit.
I think that's a really good starting place when talking about debt too, because it is, very much, very much focused on credit score and how that affects it. So what is a good credit score, Nicole? What is something that we should be looking at?
So this is a really good question. So what a lot of lenders will consider a good credit score is anything in the 690 or above range, right? So a lot of people will call me, they'll say, hey, I need a loan. What does my credit score have to be? If you are 690 or above, it's fairly likely you're going to have some option for the debt you're seeking. But all these different pieces of the credit score matter. So if you're in this 720, 850 range, that's excellent. You're probably getting the best rates. You're probably getting the best payback terms. Your lender is probably looking at your application for a loan thinking, this person's going to pay us back, so we'll give them the best deal we have. If you're in that good range, this 690 to 719, a lot of times what I would see is maybe our credit card utilization is high, but we don't have a lot of late payments or charge-offs. We're still paying back the money that we owe. And then once you get under 690, it gets tough. So many people call me, and a lot of times they'll tell me, Nicole, my spouse doesn't know this is going on. We've had late payments for X amount of months. We have charge-offs. I just don't know what to do. And every time I say, man, I wish you would have called me when you were above 690. So we could have talked about options before the score got low. There are other options though. Like I've seen lenders who have been able to do loans when you're in the 500s. I've even seen a lender one time be able to lend to someone who was actively in a bankruptcy. So it's not ideal, and they definitely didn't get great terms, but this is kind of the way we're looking at credit scores.
And so when we think about, I think a lot of times with credit scores, it's a bunch of numbers. And I think that's where a lot of the times, some of the education can end is, well, these are the credit scores that you should be looking at. These are good, these are bad. I don't know that there's a lot of explanation about what is going into credit scores. What are these numbers even made up of? And so maybe you can go into a little depth on that.
Yes. Okay. So people always ask me, well, what even makes up a credit score? And there's a lot of confusion around this, right? We do know if we pay on time, looks on credit, right? So what's interesting is if you've never pulled your own credit report, you can actually pull your credit report and you can look and see what's on it. And what you'll notice is I can see, say you have a car payment, I can see every single month of that car payment for the past 7 years, whether or not you were on time. So it's tracking every time you make a payment on time. We're saying, hey, that's good character. This first C of the credit, it's showing us a good repayment, right? What also goes into credit is your capacity. So your ability to repay the loan, which a lot of people talk about your debt to income. What this means is the lender is saying, hey, how much money do they make? That's why they're asking about your income, because they want to compare based on your income to your debt. Can you afford these payments? As a lender, it would be irresponsible to lend knowing, hey, this person's not able to meet their monthly payment. The other C of credit we often see is collateral. So if you ever get asked, do you have something you can secure this with? A home loan is a great example of this. When you get a mortgage, that mortgage is typically secured by the home. So what does that mean? If for some reason you don't pay back your mortgage, the bank can typically take your house if it's the collateral. And then a lot of times in credit, we're also looking at capital, which is a borrower's personal investment in the project. So an easy example of this can also be on the home loan, right? How much money can you put down on this home loan, right? The higher that number goes up, the less of a risk you are to the lender. So you kind of have more skin in the game. So we look at that. And then there are just different conditions, like what's the purpose of the loan? What's the interest rate? All these factors will come together. Your credit report is almost like a job application, but for a loan. It's really a lender looking at it and saying, do we think this person is going to pay us back? Not do we like this person? I've had the first time I went to get business debt, I was absolutely not qualified. I didn't know this. And I went to the banker, and this banker loved me and believed in me and saw the vision of the business I wanted to create. But she just said, hey, there's no way. And here's why. So, as hard as that was, and even though she believed in me, that was the first time I really learned credit matters.
Yeah, absolutely. I think those are really good points. And, again, maybe something that's not extremely groundbreaking today, but really good, just general knowledge and foundation to keep in mind. But I think when we dig a little bit deeper into some of these five C's on what is going into them, what are good levels, that's another thing that we've always heard, it's always good to have some debt. You kind of have to have debt to get, loans. But what's the ratios? What are we looking at? Where's that ideal place to sit with our finances?
Yeah. And so a lot of times they'll say you never want your debt to income ratio, you don't want to get over 30%. A lot of people too, they'll come to me and they'll say, hey, I've never had credit. I grew up like that. My parents taught me, which I'm still grateful for, if you can't buy in cash, you can't afford it. That was just what they said in our family. And so, well, then I needed an apartment. And when I applied for my first apartment, they wanted to pull credit. I didn't have any. So in that situation, what I did was I just went to a local credit union and I got a $500 secured loan. I gave them $500 that they held an account, and every month over a year, I paid that off to build my credit because those things do matter. A lot of people have questions about what causes a credit score to go up or down. I am always shocked at how much a single late payment can impact your credit score. That's something I hear a lot too. People tell me, I had this great score, we'll pull it. It's gone down by 20, 30 points sometimes. And it's usually not a ton of activity that caused that. Sometimes it can be a single thing. Um, what also affects your credit is applying for credit too often versus having no credit history. We've kind of talked about that. I do want to talk about applying for credit. So what's really interesting is a lot of people throughout my life have told me, hey, let me pull your credit, but don't let anyone else. So the credit bureaus actually want consumers to shop loan options, but it has to be done in a specific window and a specific time frame. So say you're going to buy a car. You're going to buy a car, you have one lender pull your credit, they give you your loan options. You typically have a 15 to 30-day window where you could go to another lender, ask for a loan in the exact same amount for the exact same type of car, and this only counts as one inquiry on your credit report. And the reason the credit bureaus did this is because they said, hey, lenders have a ton of different loan products. There are some lenders who are really great at construction loans, or they're really great at car loans. And so we want to give you the opportunity to talk to these different lenders, find what they're best at, and for you to find what's best for you too. Another thing that comes up is co-signing on a loan or a credit card for someone else. A lot of times I'll hear, oh, I just co-signed. It wasn't actually my debt. So the way we view it on your credit report is if you co-sign, it's your debt. It still shows on your credit report. It still belongs to you. There's a reason you put your name behind that. Charge-offs and collections versus current payments. So charge-offs typically happen if you've been late on a payment for 6 months. It can be less, it can be more. It's different with every lender. A lot of times that lender might charge off the debt, and that's when you're getting those collection phone calls. This is a really scary place to be. I have been there. It was not fun. What I wish I had known was you can typically call, update your lender on the situation. Don't ignore their phone calls. Tell them what's going on. If you've had an income loss, if you have unexpected expenses, talk with them. Oftentimes they're willing to say, hey, how long is this going to last? Is it 3 months? Maybe we can put you into a payment plan that doesn't have interest over this while this happens. Or maybe we need to negotiate a payoff for this. It's just really important to talk with them, because you'll find what I found is that you often have more options than you think you do.
Yeah, and I think that we tend to we've been told certain things throughout our lives, and some people are very opinionated about credit, and pulling it and how much you should have. And the idea, I think, of going to multiple different places is a little foreign to us, because we do think, well, that's they're going to pull it multiple times and that's going to hurt my credit score. And that's just things that we've been told. One other thing that I wanted to ask about, though, is a hard pull versus a soft pull. Those are terms that I've heard, and this is kind of an off the cuff question that I just thought of, but what's the difference between those two?
Yes, that is an amazing question. So if the difference between a hard pull and a soft pull, so a soft pull is just for informational. So when I was a mortgage lender, someone might submit part of an application and they might say, hey, I'm really nervous about my credit. I don't know that I want a hard pull. So while I couldn't pull their score, I could pull what's on their credit report. And so we could see what your debt to income really looks like, and it didn't hit their score. Now, when they really wanted to get that mortgage with me, I had to do a hard pull. A hard pull is hey, we're pulling not just the information that's on your report, but we're pulling your score to determine whether or not we can qualify you for this loan. For me, it's just been a lot of times, especially if you're really on the fence, we might soft pull it just to help you feel comfortable with it before we move forward with the hard pull. I've had times where someone says, oh, this is amazing. Go ahead and pull. I want to apply. And I've had other times where they've said, oh my goodness, I didn't know this was on my report. I need to go call some people before I pursue credit.
Interesting. No, so you do have the option to ask, can we, soft pull it first? Is that what I'm hearing a little bit?
Yeah, a lot of fraud that can surround credit scores because they are attached to your social security number. So I always tell people, don't click on random links. There's a website called annualcreditreport.com. This is where you can pull once a year, you can pull your report from each of the major credit bureaus. So there's these 3 credit bureaus, Experian, TransUnion, and Equifax. You can go on annualcreditreport.com. I do this every 4 months. Actually, I go pull one of mine. I don't pull them all at once because I like to just monitor it a little more closely. But that will allow you to see what a lender would see in a soft pull. You can see what's on it, if there's anything you need to dispute. If you see something on your report that you didn't know existed, reach out to the lender, figure out what's going on. I've had some people where it's, and oh my goodness, I had a retail store credit card that charged off for $100 in debt. I could have paid that $100, but I just completely forgot that when I turned 18, I applied for that credit card. And that's where it is. So it's important to kind of monitor these things. We've talked a little bit about shopping loan options, but one of my other favorite things I've learned as a lender is that you are often able to negotiate rates and fees. So it depends on the type of loan it is. Have you ever wondered, say you go to a car dealership and you apply for an auto loan and they tell you, oh, well, I have a couple different rates, a couple different options from a couple different lenders. This is because there's so many different loan products that exist. I have clients all the time who would come to me and say, hey, you offered me a 7% on this, but this lender offered 6.9%. Here's what their fees look like. Here's what yours look like. Can you do any better than this one? And I just, growing up blue collar like I did, I would have never imagined asking a lender, hey, can you give me different on this? Can you match this person's? But that is absolutely part of financial literacy. The more I talk with groups, the more I get phone calls where people are saying, hey, can I do this too?
Yeah, no,
When
I
you're
love
making
that
these,
actually because I didn't realize that you
yeah,
could
go ahead,
you
Brandon.
know go back and ask for a better rate. I always figured the rate was the rate. So that is certainly something that I'm going to do in the future.
Yeah, and sometimes it is like there are certain on a home loan, right? In Tulsa County in Oklahoma, right? There are some specific loans where the county sets the rate, especially government-backed ones, where it's not negotiable, but it just depends. So the whole point is to get us in a mindset of asking questions. There are so many different terms when you're getting a loan. Like what's amortization, maturity term? What does that even mean? It's how long it's going to take you to pay back the loan. It might be a 30-year home loan you pay back monthly. It might be a car loan that you pay back in 2 to 6 years. There's interest rate. There's, is it secured or unsecured? Is my rate fixed or is it adjustable over time? What types of fees create the APR? Um, so we're just going to do a quick, we only have a couple more minutes. I'm going to tell you some of my favorite things I've learned about the most common loan products people have asked me about throughout my lifetime. The first one, car loans. Something really interesting I learned is that when you go into a dealership, a lot of times they're working with a lot of different lenders and there are commissions that they make off of those loan options. But they don't always show you the only loan options you have available. So this is a great situation to where some people say, "Oh, I thought I had to get the loan right then." And sometimes they have great loans. I've gotten a loan and the dealership has had the best option. They will let you, if you want to call a credit union or call your banker and just say, hey, these are the terms I'm getting here. What are the terms I'd have with you? Oftentimes, they're going to wait for you to do that because they still want to sell you the car. You don't have to make the decision right then just because you're sitting there right now and you're going to lose the car. Oftentimes, I would have clients sitting in that office with a car that they really wanted. And all they would do is I would say, hey, I can do this loan for you. Let me talk to the person you're working with. I'll send them a letter. It made them comfortable. They would hold the car. Um, Home loans. So one of my favorite things to tell people about home loans is when I was a mortgage lender, I had over 1,000 different loan options I could put a client in home wise. So depending on what your profession is, I've seen specialty products for physicians, attorneys, dentists, teachers, first responders. Depending on what your profession is, depending on where you're buying a home. There are different zip codes that have different loan products available specifically in those zip codes. There are loan products that tie to different religions. Depending on what you're looking for, I always tell people if you're buying a home, talk to a couple different lenders, see what's out there. Because for me, there was no way I could keep up with 1,000 different products. I had my ones I was really good with and that people called me about the most. But I know as a lender myself, there were things I was missing just because the sheer volume of what's available. So ask a lot of questions. And then one of my favorites, but least favorites, payday loans. So I don't know if you're familiar with payday loans. Kind of how they work is you go into a place and you show them you're getting a paycheck a week from now or 2 weeks from now. And they will give you a loan that basically gets you your paycheck earlier than you were supposed to get it. The problem is these loans are super predatory. And I'm going to show you an example of what this looks like. So say you go in to get that payday loan and they say your interest rate on this is 14%. And you're thinking, well, I've got to get my car fixed because I need to get to work and I have a couple more weeks. I've got to get this done, or I've got to pay my kids tuition, or else they're getting kicked out of school. So 14% is worth it trade off wise for me. This is where APR comes in. Your APR actually is your annual percentage rate. It's what you're really paying for the debt. This includes all of the fees that also go into your loan. The last time I was working on something like this, I saw an APR over 391%. Now, people don't think about that, right? Because we are trained that interest rate is the only thing that matters. But fees can have a significant impact on what you're paying back debt wise as well. So I always tell people reach out to someone like Brandon or whoever you work with at Summit and just send them. Say, hey, here's this loan option I was given. Do I need to ask questions? Does this look okay? But it's a great place just to get in a mindset of we're asking questions about these things. We're not talking about it in silos. We're not being that 68% of people who would rather talk about weight than our money.
No, I love that. I am, so in agreement there. A lot of the times for us, again, it's questions that we don't think that we even can ask. And I think that was my biggest takeaway from today and in our prep meetings was just that, those are things that I didn't even, really think even me that I should be, asking about a different rate. I've always kind of thought the rate was the rate. And that's what we were getting. So, but asking those questions, being inquisitive, I think is super important. And thank you so much, Nicole, for your time today. I know, again, we've talked about some things that, like I said, might be a little bit on the 101 of financial literacy, but it's so important and it can impact in so many ways down the line, especially, as we get, right out of school, like you were saying, being in college, not really maybe taught some of these things. So maybe this is a presentation that you can share with your kids and, those that are, heading into college as a good way to start the learning journey on finance. Again, thank you everyone today that joined as well. I hope you found the information valuable. If anyone on the call does have further questions about debt, how it affects your financial picture, please do not hesitate to reach out to us at Summit. We're happy to help and get a plan together for any walk of life. Like as Nicole said, it really doesn't always have to do with income levels. It's about, our financial decisions and our financial literacy. So I think that is really important. We actually do have a few extra minutes here, and we did have a couple of items come through chat, Nicole. So I really wanted to just touch on one or two of those real quickly if we could. Statement date or due date to increase credit score. And I'm assuming that's when we're paying off our credit card, on the statement date or the due date. What's the difference between that?
Brandon, I'm sorry. I think it cut out. Oh, let me see the Q&A.
Yeah, so statement date or due date to increase credit score. So I think that's, when are we paying things off?
Great question. It doesn't matter. So paying it off, if you pay off, make a payment 15 days early, it's reported on your credit the same way as on time. So unfortunately, they get you if it's late, but you don't get anything extra if it's early. So.
Well, that's a bummer. That really is. You should get like a if you have one late, then you can exit out with paying one early, something like that. That would be fantastic. Credit Karma, is that a reliable source for credit information?
This is an amazing question. So I would say Credit Karma is reliable when we're thinking of soft pull, like informational, what's on my report. I have had a lot of unhappy clients tell me, hey, my Credit Karma score said it was this. Why are you telling me it's this? And the reason there could be discrepancies in that is a lot of times when a lender is doing a hard pull for you, you've applied for debt, we are pulling a score that is basically the median of all three scores. Typically on a Credit Karma or other platforms that you might be using, a lot of people will look at their score on their credit card apps as well. They're pulling from one of the bureaus because that's how you pull for a soft pull. So I've seen it be up and down. I've seen people pull it on Credit Karma, then come tell me, hey, the score you gave me is amazing. How'd you get there? But I've also seen it the other way. So
Yeah. And then one that just came in, where can I find my actual credit score? It's different everywhere. So what should I hone in on?
yes. So on your actual credit score, it's really going to be when a lender pulls it. There aren't, at least that I've come across, we live in a big world with a lot of options. I haven't found a tool where you can pull your score and know what it is. And also, a way to think about that is your credit score is changing every day. So based on something that happens with your payment history tomorrow, it could affect it. And I think that's part of why they don't just publish the score. It just happens when you pull it.
Okay. Thanks. Well, Nicole, thanks for taking some extra time to answer those questions. Lastly, I'd be remiss. I know Matthew's going to talk about the logistics of our next webinar coming up. But we are doing family love letters again. We did this a couple of years ago, really going over trust, wills, and real life applications of legacy planning. We had so many people that joined last time we did it, tell us how valuable it was. So we are doing it again next quarter. So shameless plug, next quarter, be on the lookout. We're going to continue to send communications like we always do. But I think that's just such a great needed webinar that everyone found valuable. So we're going to do it again. But with that, Matthew, I will turn it back over to you to close us out.
Yeah, I'd like to thank both Nicole and Brandon for their time and for sharing this informative and valuable information with us. We'd also like to thank all of you for joining today's session. If you have any other questions or would like to be connected to a resource at the Summit, please email bschultz@yoursummit.com, as we'd be happy to assist you. And to look ahead, just as Brandon mentioned, please mark your calendars for our next quarterly educational webinar, Family Love Letters, Anticipating the Unexpected, which we look forward to holding on September 4th, 2025. Please be sure to follow us on social media to stay up to date on market trends, legislative updates, and tips and tricks to help you pursue your retirement goals. As always, thank you for joining and letting us help you reach your summit. Thanks, everyone.